It's great to have back on the program today Bob Deitrick, co-owner of Polaris Financial Partners, our great new underwriter, as well as co-author of Bulls, Bears, and the Ballot Box. And Bob, it's so great to have you on because as President Obama now gets into the last couple of years of his second term, outgoing president, more and more is being discussed about the Obama legacy. And on this program, we've talked so much about the long list of issues that we have with President Obama. But one area where I feel that President Obama is getting no credit is when it comes to the economy and fiscal issues. President Reagan often is kind of considered the gold standard for fiscal conservatism and a strong economy. And as you've been talking about and researching and writing about for a while, President Obama actually does quite well when compared to the economy of Ronald Reagan, doesn't he?
He really does. Actually, I wrote by the way, it's good to see you, David, and all your viewers. Happy New Year to you, by the way. Thank you for having me on again.
Thank you.
Yeah, actually, the reality is that we did an article about comparing Reagan and Obama about a year ago, and actually on 12 different metrics, Obama beats Reagan on about 10 of the 12. So it's fairly astonishing to me that the Democrats have done a pretty meek job of really conveying what a great job this president has done, economically speaking.
Okay, and let's talk about what the metrics are, because the most important thing if we're going to evaluate one president versus another is to say, how are we measuring the strength of the economy? So talk to us about that.
Well, one of them is unemployment. The reality is unemployment now stands at 5.8%. At this very same time in December of 1986, unemployment under Ronald Reagan was actually at 6.9%. So we're a full point lower than where we were during the Reagan years in 1986 at the same time. The reality is we're also on a trajectory now where I think we're going to see unemployment in the mid fives to as low as 5% by the end of this year. We had a really good jobs month in November. We created 321,000 new jobs in the month of November. We'll find out this Friday what December's results were, but we're looking at somewhere between 2.8 to 2.9 million new jobs created in 2014, and that's a great number by any metric, and better than a lot of the years that we saw under either Reagan or Clinton.
So let's along those lines, Bob. Let's examine two of the primary critiques that we hear from the right when people state the numbers you just stated. One critique is, okay, Bob, the U3 is dropping as you state, but the U6, in other words, if you include discouraged workers and underemployed workers, the U6 is particularly bad under Obama. Is there any truth to that at all?
That really is entirely a misnomer and a red herring in my view. The reality is the U6 has been around through the 1980s, and it was actually as high as almost 19 or 20% in 1983, 1984 under Reagan, but we never talked about it. That was never politicized at all until here in the last couple of years. The Republicans have done a great job of politicizing the U6 and making that a big issue when in fact the reality is it's not. During the Bush years, the U6 was as high as 12 or 13% when unemployment was at 6. That always had existed. You're always going to have some degree of discouraged workers. Again, keep in mind the U6 includes high school folks in high school, folks in college, some retired workers, people who are marginally employed, people who are part-time employed, and the U6 has never been politicized until Fox News decided to do so here in the last couple of years.
Okay, and then the other one is we hear talk of wages, right? Which is that even though we know that when you start having jobs recovering, wages recover with some lag time behind jobs, that the wage change right now is particularly bad. What about that? What do we know about wages?
Well, again, keep in mind we haven't had an increase in the minimum wage since 2009, and we really are due for another one. That would help that situation a lot. In some of the states this year, in January 1st, we saw in 21 or 22 states, they increased the minimum wage. We really need to see a federal increase in the minimum wage from $7.50 as well. If we did that, that would help bring wages up across the board. So that's the one thing, unfortunately, I don't think we're going to see in this Congress either.
Okay, so that kind of talks to us about labor and employment. The other side of the economy, and this, of course, doesn't touch everybody because a lot of people are not directly invested in the stock market. Some people may be indirectly invested, maybe through a 401k or their employer's retirement. But another place to look at would be the stock market. What is the story as far as the stock market under President Obama versus past presidents?
Again, great question, David. And the reality is that the market has actually done better under this president from March of 2009 to the end of December of last year, last week, done better under this president than it did under Clinton, Reagan, FDR, or Kennedy and Johnson in the 60s. This has actually been the greatest secular bull market we've seen in this country, and yet you'd never know that because the Democrats have done, in my view, a poor job of conveying that message. So we're very happy because we've had our clients in the market. If you've been sitting on the sidelines, obviously you're not too happy. But if you've been in this market since March or since the spring of 2009, you've done extremely well.
All right, let's talk about oil prices a little bit. Earlier in today's program, we talked about how oil prices yesterday dipped below $50 a barrel, ultimately closing, I believe, just above $50 a barrel. You hear these quotes from Wall Street that there are some investors who are actually starting to get a little scared because the price of a barrel of oil may be getting too low. Talk to us about that. As someone who is advising people about what to do with their money, what do you get out of the significant drop in the price of a barrel of oil?
Another great question. I think that what we're seeing now is we're purging, if you will, the Bush years out of our system completely. And I say that metaphorically, but the reality is, let's take a look at the facts. Before we invaded Iraq, the price of oil was $18 to $20 per barrel. One of the selling points that the Bush and the neocons gave us for invading Iraq was that we'd have $20 per barrel oil in perpetuity. Well, that obviously didn't work out too well at all. The price of oil quintupled, if that's a word, from $20 to $147 per barrel in 5.5 years. The price of gas quintupled. It went from 88 cents a gallon down the street here at the local filling station to $4.79. It now has gone back to $1.71 as of this morning. But the reality is we're now getting back to, I think, a pre-Iraq inflation-adjusted price of oil, which will be somewhere between $35 or $30 and $40 per barrel.
So you actually anticipate a significant drop even from the 50 that we're at now?
I think we're at actually 48 today, and the market's trying to digest what's happening. It's going to take a couple weeks for the market to realize that this is really a good thing for the economy. Keep in mind that the S&P, 8% of the S&P is oil-related. The other 92% is non-oil related. I'd rather own the S&P knowing that the 92% are going to benefit dramatically by oil coming down in this way. It's going to benefit the consumer in a huge way also because it's basically, in effect, a big tax cut for the consumer that's going to amount to somewhere between $800 and $1,500 per year for every single person or family driving vehicles. This, to me, is a great thing that's going to ultimately be very good for the market.
So you're not buying the kind of supply side voodoo economics fear mongering that while gas prices used to be too high and that was President Obama's fault, now that we're seeing them drop in concert with the price of a barrel of oil, that now it's too low and it will be destructive to the economy. You're not buying that at all.
No, not at all. I think that's entirely untrue. That is a red herring. There are some folks like Bill Gross who came out this morning who was also, with all due respect to Mr. Gross, who's a pretty wealthy man, he was totally wrong on QE as well. He predicted that QE would cause much higher interest rates, higher inflation, a huge fall in the stock market. This was only up until about a year ago he was making this prediction, which was totally wrong. He came out today and said that this is going to be a bad for a lot of asset classes in the stock market. I totally disagree with that. I would rather own the S&P with oil at $30, $35, $40 a barrel than the S&P at oil being at 110, which is where it was a year ago, by the way.
Is it true or untrue that when the price of a barrel of oil drops, those in the oil business actually have a decrease in profits, or does this not really affect the profits within the oil industry?
Oh, it certainly affects their profits. I mean, Exxon and Chevron and a lot of the major oil companies have had record profits that have been exponential and asymptotic in the last couple of years. And I think it's going to affect those who are producing oil out of shale and out of other classes that are much harder to get at. That's going to affect them more dramatically. But I think overall, they still, again, keep in mind that when oil was at $20 a barrel, which is where it was for the majority of the last 50 years, oil companies still were making profit. So I don't, quite frankly, feel very bad for the oil companies right now.
We've been speaking with Bob Deitrick, co-owner of Polaris Financial Partners in Columbus, Ohio. Also, check out the book Bulls, Bears, and the Ballot Box. Bob, great as always to have you on.
David, pleasure to have you on. Pleasure to be with you. Thanks so much.